Riding on the digital and healthcare boom, e-pharmacy retailer Sastasundar Ventures has delivered exceptional gains for investors within the past year. Last month, the company announced a strategic partnership with the Flipkart group, wherein the e-commerce giant will acquire majority stake in SVL subsidiary to gain foothold in the health tech arena. The investment by Flipkart validates our investment thesis on the company and opens up new growth avenues for SVL. Flipkart has agreed to acquire majority stake in Sastasundar Marketplace, the B2C platform operating the online portal Sastasundar.com. As part of the deal, SML will transfer 75.1% stake to Flipkart Health Private Limited for 1,061 crores. SVL, which is the parent company, will continue to hold the balance 24.9% stake in SML. The combined entity will leverage the strengths of both Flipkart Group and Sastasundar to deliver end-to-end offerings to consumers in the health tech ecosystem. As social distancing and remote working became the new norm during COVID-19, Sastasundar's platform gained immense popularity. Meanwhile, the pandemic also led to a considerable shift to online purchases. The business registered a surge in revenue as more consumers moved online to order medicines. The company reported strong H1 results and its total revenues were up 20% year-on-year to 332 crores. Sastasundar follows a multi-channel strategy for inventory procurement as it sources products from pharma companies as well as distributors. It currently operates across 3 regional clusters through its warehouses in Kolkata, Mumbai and Delhi NCR. Post the capital infusion from Flipkart, the company plans to penetrate deeper and wider into the Indian market by adding 8 to 10 new warehouses to expand its online presence over newer markets. The business integration with Flipkart is underway and the process is expected to complete over the next 6 months. Meanwhile, increasing internet reach and mobile penetration, growth in preference towards online shopping and home deliveries, and greater focus on healthcare services are the key reasons driving the boom in the digital pharmacy industry in India. At present, there are close to 50 e-pharmacies in India and the market size is around $500 million, approximately 2 to 3% of the total Indian pharmacy sales. The market is expected to grow at a compounded rate of 20 to 30% to reach $5 billion by 2025. With the increase in retail discounts, Sastasundar's gross margins have taken a hit in the last couple of quarters. The trend is anticipated to continue as the industry is experiencing severe price competition, which will result in lower gross margins for the near term. Meanwhile, the overall cost base is also expected to swell up in the next 12 to 18 months as the company will invest aggressively in warehouses, people and technology to build pan-India distribution capabilities. Therefore, the operating margins will remain under pressure. Since our initiation of coverage in November 2020, the stock has undergone a swift re-rating, having more than quintupled in 12 months. While the deal with Flipkart is truly a landmark development, near-term operating losses are expected to widen due to planned business expansion and integration. In the medium to long run, the business has ample opportunities to scale up revenue on the back of favorable industry tailwinds and recent developments. As the prevailing valuation, an EV to sales of 2.3x offers limited margin of safety, we believe it's wise for long-term investors to wait for some correction to initiate fresh positions. Margins in e-commerce business are already wafer-thin and growing consolidation in the industry could make things worse over the short term. In addition to competition, government regulations related to e-pharmacies pose another threat to the growth prospects of the company and the sector.